In this module, we are going to discuss a recent PCAOB publication on journal entries called Audit Focus Journal Entries. There's the URL if you want to read it. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. And I think what this document is telling us is that we perhaps haven't followed professional standards, and or if we have, we haven't documented what we have done properly. Now it's an Audit Focus. They publish these every once in a while, January the 16th, 2025. It's a staff publication. And they say it's especially for auditors of smaller public companies. Now, a smaller public company in the United States is still rather very large. It's not as big as a large public company, but you're still talking some very large enterprises with a very large number of transactions. And they say staff identified a large number of deficiencies related to the examination of journal entries and other adjustments. This standard's been around since 2010 and before. So that means people haven't been paying attention to this for at least 15 years and perhaps longer. And the other observation I would have, it's not just journal entries, it's other adjustments. Now there are no such things perhaps in a very small private company, but if you're doing a consolidation, there can be some rather large numbers, entries, adjustments moving around in the consolidation process. Now, my experience, I often helped the client do the consolidation, and I perhaps knew more about it than they did. But one of the things you did was you said, okay, have we made all the adjustments that we made last year, all the eliminations we made last year, and are there any new adjustments this year? So you have to pay attention as an auditor to the consolidation process, because people could be messing around there, perhaps making a mistake unintentionally. That would be bad. Doing it on purpose is worse. Now, I'm going to assume that all PCAOB found were documentation deficiencies. Maybe we did this, but we didn't document it well enough. Maybe they found some performance deficiencies. Maybe we didn't look at entries throughout the year when maybe we should have, or maybe we didn't document why we decided that it wasn't appropriate to document looking at journal entries throughout the year. Okay, so didn't find the financial statements to be wrong, but don't wait till that happens. Finding fraud is extraordinarily difficult. It's not easy to do. You will often find it as an error, not as fraud. So here's some things that you are required to do and document. Don't wait till the financial statements are wrong, and this has been around for 15 years. Now, as an aside, where does all this silliness come from? How could there be a material misstatement created by journal entries? That's impossible. Well, there was a fraud called WorldCom, which occurred in 2002, perpetrated largely with journal entries. Amazing. And Sarbanes-Oxley caught on to that, made some recommendations. Hey, why are auditors not looking at journal entries? And as a result of that, standards changed. Now, the fraud, and I'll let you read more detail about it if you wish. It's available on Wikipedia, for instance. But briefly, a whistleblower who kind of caught on to what was going on got fired in March of 2001. And by May of 2002, he'd been interviewed by a newspaper reporter, was published, and the article was read by Internal Audit, who went, hey, maybe we should look into this. And so they started their capital asset audit early. And they found something called prepaid capacity. They were making journal entries based on prepaid capacity. And they didn't understand, and I didn't understand, and nobody understood what that meant. But following that up, internal audit found $3.8 billion in incorrect journal entries going debit, property, plant, and equipment, and credit expense. In other words, increasing income by 3.8 billion. So by June of 2020, they went to the audit committee, and the audit committee got on the case. The auditors were advised the 2001 audit opinion was withdrawn. The external auditor resigned. In the end, the fraudulent financial reporting was $11 billion, and people went to jail. So you, as an auditor, didn't want to be anywhere near this. And there were two auditors involved, actually. I'll let you read that. But it's basically internal audit that found it, and good for internal audit, though look at how long it took. These things are not easy to detect. And initially, internal audit was going, what was going on? And they actually were doing things like working at night so people wouldn't notice what they were doing, because this was perpetrated by senior management. And it was senior management that went to jail. Now, as an aside, as we think about all auditors, there are other ways to have found this other than journal entry tests. Analytical, property, plant, equipment testing, understanding the business. Though in this circumstance, this is such a large organization, and they were doing it through many journal entries. It might have been that the only way to figure this out was by testing journal entries. But I think the other thing I would say, before you launch off into testing journal entries, you need to have a broader understanding of risk of material misstatement. Just start testing journal entries, you're not going to find anything because you don't know what you're looking for. But it does mean, I think, that in a very large entity, this is something you need to pay attention to. Now, PCAOB didn't just say, hey, you've got to go test a bunch of year-end journal entries, and hey, you've got to go and test a bunch of entries throughout the year. That's not what they said. They said you need to use professional judgment to determine whether or not you need to do that, and you might, I guess, conclude that you didn't. And you need to assess risk of material misstatement of fraudulent financial reporting, and based on professional judgment and risk of material misstatement, that will determine your extent of testing. Now, as you're assessing risk of material misstatement of fraudulent financial reporting, probably wise to do the risk of fraud or fraudulent financial reporting and error together, because often you're only going to find the fraud as error. You may only find it as error and never recognize that it was deliberate. But be sure to think of that. Be sure to have in the back of your mind, as you're assessing the risk of material misstatement and saying, yes, I've done it, and I thought about fraudulent financial reporting and error together, and here's what I thought. So PCAOB is telling you to do exactly that, and that's what you should do. So they weren't telling you to go off and do a whole bunch of testing mindlessly. They were telling you to think about it and do what is sensible. Now, all auditors should be aware of this, and particularly public company auditors, large and small. And it applies to all audits, large and small. And public companies are particularly large. And a small U.S. public company is still really big, and not small in any way compared to some of the very small audits that a small firm might have. This still applies to the auditors of small firms. Now I'm going to quote the relevant professional standards. I'm using international auditing standards. They're more broadly applied than U.S. standards, but the U.S. standards and the IAS are highly similar. So 315.26 tells us that we have to identify the controls over journal entries. And if we then read 315A160, it says in a less complicated entity, we may not plan to rely on operating effectiveness. We may not need to evaluate design and implementation. And the auditor may determine that there are no identified controls other than the entity's controls over journal entries, which I think they're trying to tell us are pretty simple. So that can be very simply and easily done, but it's something we have to do and think about, probably document. Now, scalability, what does this mean? Now, clearly for a large US public company, which are very, very big, they're enormous, billions and billions of dollars in revenue. So lots more has to be done in a large public company. And even in a smaller public company, lots more has to be done. For a medium-sized entity, more, but for a smaller entity, and that's different people have different attitudes or ideas of what a small entity is, but less for a small. And if we're talking a very small entity, we are auditing a single location daycare. It's a very, very small entity, and we need to use professional judgment. We need to decide and think about risk and material misstatement and use professional judgment and decide what we need to do for each of these sizes of entities. Now, 240.33a, the fraud section, says test the appropriateness of journal entries and other adjustments by making inquiries about inappropriate or other unusual activity around journal entries, selecting journal entries and other adjustments, consolidation adjustments, for instance, made at the end of the reporting period. Now, technically, 240.33a II doesn't say we have to do anything other than select them. If you read that, they've kind of written it wrong. But by the time you get to 330.20b, it says examine material entries. So those two paragraphs read together, we're going to select them and examine them. And then consider the need to test journal entries and other adjustments throughout the period. It doesn't say you have to do it. It says you need to think about doing it. And in a very small audit, you might say, I thought about that and there's no need. Because basically the only journal entries are journal entries that I, the auditor, have proposed. So I really don't need to do that. And it's very simple, and I've assessed risk of material misstatement, and I don't need to do it, which is what PCAOB would agree with, because they said assess risk of material misstatement and use professional judgment. So you've done that. What do we have to do with the journal entry testing then, and to be a little more specific? And we're going to talk about large enterprises, moderate-sized enterprises, and small enterprises. And of course, within each of those categories, there are very, very large public companies, there are moderate-sized public companies, and there are small public companies. But even a small public company is large. And I'll keep mentioning a single location daycare as a small audit. That's a very small audit. And there are different sizes of small audits, and a medium-sized audit going to be somewhere between large and small. It could be that on a medium-sized audit, what's appropriate for a small audit is all we need to do. And it could be for a medium-sized audit, things we need to do on a larger audit are what we need to do. Now we have to inquire of management whether they're aware of inappropriate or unusual activity around journal entries. So in a small audit, and indeed in every audit, I'd like to get a written representation from management that they are not aware of inappropriate or unusual activity around journal entries. I'd like that signed by management, and I'd also like that signed by someone from those charged with governance. And I think I want that representation in every audit. Now, is that enough? And it might be, probably is, in my small daycare, that's enough. There's not that much going on with journal entries. We should know that. Risk and material misstatement, professional judgment, that's all we need. Now, I like it signed by management. I don't like making that inquiry and documenting it in the working papers, because later management might forget and say, I never said that. So I'd like it in writing from management in the representation letter. And I want that in every audit. But in a larger audit, Are we probably going to be doing lots more than just that? Yes, probably. If we look at 315, there are a lot of things in 315 that it suggests we do surrounding journal entries. So in a large audit, professional judgment, risk and material misstatement, we're going to be doing more. Now, we are required to select year-end entries and test them in 330. So in a small audit, perhaps there are very few year-end entries that the client made. Perhaps there are none that the client made. Perhaps we have already tested the journal entries. The client made a journal entry to record annual depreciation. We've tested property, plant, equipment, fixed assets, and we found that the depreciation was properly calculated. So we've already tested that. Also could be that either most or all of the year-end entries / adjustments are ones that were proposed by the auditor. So we've already done it. In a large enterprise, probably lots that we should be looking at. Again, risk and material misstatement, professional judgment, and a medium-sized enterprise somewhere in between. But for a small enterprise, we probably, all we have to do is conclude that we have tested an appropriate number already. No additional work. Now, the third thing we have to do is consider testing journal entries throughout the period. Now, how could a client possibly commit fraudulent financial reporting that was material by journal entries throughout the period? Well, the answer is WorldCom. But in a small audit, probably not. We're probably going to decide that based on our testing of transactions and balances already done, that we don't need to do any journal entry testing throughout the period. And perhaps there aren't any made throughout the period. They record their transactions, and then they rely on our help at year-end to propose adjustments. In a very large enterprise, WorldCom, if we were auditing WorldCom, we would probably be glad to have tested entries from throughout the year. But if what you do is say, oh, okay, I've got a large enterprise, really don't know what risk and material misstatement is, but, oh, I'm just going to pick 60. I'm going to pick some from January and some from February and some from March, and I'm going to agree them to approval by management, and then I'll be able to say, look, I satisfied that requirement. Well, assessing risk of material misstatement, we're probably going to want to target our entries better than that, the entries we select better than that. And we're probably also not going to want to just agree it to approval by management, because the principle here is that management is trying to fool us, so of course they've approved it. So agreeing to approval by management is unsatisfactory, and we're going to have some kind of protocol of agreeing to supporting documentation. And because we're concerned about fraudulent financial reporting, we're going to have thought about this pretty carefully. So just randomly picking a bunch of journal entries and testing them probably doesn't satisfy this requirement. Though it will produce pretty documentation, and if all you're concerned about is pretty documentation, well, spend the time doing that. But what we're trying to do is detect material misstatement, and that's probably a waste of time in detecting material misstatements. So in every size audit, we have to be sure to do and document each of these three things, and the scope of the testing, the extent of testing, is going to increase from very little in a small audit to perhaps quite a bit in a large audit. And in a large audit, we really need to think about risk of material misstatement and go looking for places where we think fraudulent financial reporting could exist. Now, recording depreciation, let's think about that in large, moderate, or small. Now, in my small enterprise, perhaps depreciation is only recorded at year-end. So there's a single year-end journal entry that records depreciation. Perhaps that journal entry is only proposed by the auditor. So very likely in that circumstance that the testing has already been done, because it was done with the property, plant, and equipment testing. So in a small enterprise, all we need is a checklist step to remind us that we may already have done it and conclude that we have. Now, the bigger the enterprise gets, the more entities and divisions and pieces of the enterprise they have, the more depreciation entries they're going to be. Public company, they're probably going to do that monthly. Certainly it'll be done quarterly. So it'll be done more than on an annual basis. So what's the testing? And the testing of this could be done in a lot of ways. It could be done analytically, for instance. It could be done substantively, recalculating it. It could be done by testing journal entries. Now, do we need to test journal entries to test that? Maybe not in any enterprise, because we are doing it analytically or substantively in our audit. And there are some things with using our professional judgment, we will determine are audited with the balance. Depreciation might be one of them. That as we audit property, plant, and equipment, we also audit depreciation, and looking at journal entries is unnecessary. Other things, remember WorldCom. They managed to come up with $11 billion worth of fraudulent financial reporting by making journal entries. So think about it, professional judgment, risk and material misstatement. Now, is this something that we have to do and document? And is this perhaps something that we might want to do and document anyway, even if it wasn't required in standards? Now, from the perspective of a small audit, this is probably a couple of checklist steps. It's a paragraph, standard paragraph in every rep letter. Might take 5 minutes to do. 5 minutes to conclude that, well, we've already tested all or almost all or enough of the year-end entries, and to use professional judgment, risk and material misstatement, and conclude, no, we really don't need to test entries from throughout the year. That would be kind of a waste of time. So given what happened in WorldCom, and given that it's a possibility, is it worthwhile having this standard representation letter paragraph and spending 5 minutes contemplating whether or not we've done enough and whether or not we need to do some more? Perhaps we'd want to do that anyway. Now, do standards require that we do it and document it? Well, 240.33, irrespective of the assessment of risks of management, override of controls, design and perform audit procedures, and then it lists the 3 we've just talked about and a couple others. So we have to do it. It says we shall do it, but it doesn't say we have to document it until we get to 240.46b, which says document the results of audit procedures, including those designed to address the risk of management, override of controls. So 243 says we shall do it, and 240.46 says we shall document it. And given what happened at WorldCom, it might just be not a bad idea to spend 5 minutes doing that. So to conclude, depending on your perspective, if you just read this requirement cold, you go, well, that's silly. I just think that's silly. I'm going to ignore it. Now, from the perspective of a large public company with large, complicated financial assets, items on the balance sheet that are all made up of journal entries, capital leases, things like that, you know, this might just well be something that needs consideration. And it's required to do and document it. So if you are in a large public company, as the U.S. regulator is suggesting you do, you need to pay attention to this. Do it and document it. And doing it and paying attention is much more important than documenting it. If all you are doing in an audit is producing pretty documentation, you are leaving yourself at risk that someone will figure out that you really didn't do it. You just did documentation. And or because the testing you were doing wasn't particularly good, you missed something. So you don't want to do that. In a smaller enterprise, it takes 5 minutes to consider and document, as I just talked about on the last slide. And it's something you really kind of want to do, consider, and think about. It doesn't take very long. And as long as we're doing it using proper professional judgment and in response to risk and material misstatement, do it and document it. It's in standards. And remember WorldCom. How on earth did they miss it? $11 billion. How did they miss it? And I'm not entirely sure that the going through journal entries was the best way to have caught it. It took the internal audit folks a long time, but not a bad idea, and also be alert to other signs other than just journal entry testing that might have found the problem. So thanks for listening.